Donald Trump in his truest elements. Let me welcome on board now Mitul Kotecha and find out what he's making of what the Fed did and what it's going to spell for the rest of the world. Mitul, hi, morning. Great to have you on the show. Mitul, along expected lines, positive impact in global equity markets so far. But how is it that you think the global markets are going to perceive what the Fed is going to do next? Because some analysts are looking at it as a little bit of a hawkish tone, if you will.
Yeah, I think, well, thanks for having me on the show. Look, I think the reality is it's a bit of a mixed picture from the Fed. They cut 25 as widely expected. The vote was very, very split. And clearly we had Miran, who unsurprisingly voted for 50. But other Fed members, such as Goolsbee, for instance, are not even voting for a cut. And if you look at the dot plots, as you say, there is some hawkish elements in the sense that the split shows that quite a few Fed FOMC members would not even be voting for any cuts or looking for any cuts. And we know that the dot plot has only one cut for next year. We still think there's a chance of two cuts next year in the first half of the year. And we do think that there'll be sufficient signs of slowing inflation and growth momentum for the Fed to cut again more than once. But clearly, when you look at the reaction, though, Treasury yields were lower, the dollar was softer, equities were higher. Gold rallied. I mean, look, markets took the cut reasonably well, and there's still hope that the Fed will cut more. But I think what we've seen very clearly is the Fed comments and statement, and what we heard from Powell suggests that the Fed is going to be very data dependent as well going forward. There was a bit of a Christmas gift for markets in the sense of the elevated the $40 billion per month purchase of T-bills announcement, which is going to help liquidity as well. So that perhaps as well has added a bit of icing on the cake for markets.
And Mitul, how should one look at the $40 billion push that the Fed is going to give in terms of liquidity stimulus? Was that largely already penciled in, or do you believe that that also has contributed to some extent, especially the move on bonds, especially the move on equities? Is that what is also causing a bit of positivity?
I think it is causing positivity. I think we have to be also careful here. It's not that the Fed is suddenly deciding that they want to increase some sort of QE or anything like that. This is liquidity management. It is a case where the Fed obviously showing some concerns about some tightening in liquidity as we're going into year end and early into next year. But it's a positive surprise. I think this was not anticipated. It is something that the markets have been reacting to. It's probably going to help funding pressures, which is what the Fed is aiming at. So I do think that's a positive for markets. It's helped, should help on a liquidity front. And I think that's going to bode well for sentiment more broadly.
And Mitul, how should one look at the Fed in the context of the next year and the year after? Clearly, the dot plot continues to indicate a rate of 3% plus, at least the terminal rate. How sustainable is that on the debt size that US already has? And given the fact that there's going to be a new Fed chair who will come in, and the government's mandate, the US government's mandate, to try and pull back on rates very, very quickly. How are these three moving pieces going to play out in your opinion? You've indicated 50 bips in the first half, but how does it play out in the medium term? Where's the terminal rate going to settle at?
Right. So look, we actually think that after 50 basis points of cuts, we will settle at the sort of terminal rate. We don't expect rates to be cut lower than that. So the Fed is starting to run out of room to ease. Obviously, yes, you're absolutely right. We'll have a new Fed governor in May next year, and obviously whether it's Hassett, Walsh, or whoever else is going to be a big question for markets. And we have to also bear in mind that whoever the governor is, you still have a Fed board that can have a vote on policy. And it's not necessarily the case that even with a very dovish, potentially dovish Fed chair, that you suddenly see the whole of the Fed swing towards a much more dovish stance. So it doesn't necessarily change the dynamic in our view. Now, in terms of the debt dynamics you mentioned, I think clearly we're not that worried about the debt dynamics, even if rates are only gradually moving lower. There's going to be, the Treasury has a lot of means and ways to try and look at the funding and issuance to try and alleviate pressures on the bond market and the debt market more broadly. We're also not really worried about a fiscal blowout. We still think that tariff revenues ought to be fairly significant in the months ahead. And therefore, we don't see any particular pressures on the bond market. So, for example, 10-year yields next year should be settling around 4%. We don't see any big increase, even with potential increase in the fiscal deficit. And as I said, it's going to be quite manageable in our view.
Right. Okay. Great to have you on the show, Mitul. Thank you for joining in with those insights.